Fed meeting today. What did they say? How will this affect mortgage interest rates in 2024? In this video, I'm going to break it down in layman's terms, right? What happened? What do we see in the future? And what's that going to mean for mortgage interest rates for you? That's what's important, right? Stay tuned. Matt, the mortgage guy, residential mortgage broker, licensed in 48 states. Greatmortgagebroker.com. That's how you connect me and my team. In today's video, I just want to break down in really simple terms what the Fed said today, what that means for mortgage interest rates. Because you're on Matt, the mortgage guy's YouTube channel, you're probably concerned, thinking about, or want to know what's going to happen with mortgage interest rates. So I'll get past all the fancy words and all the mortgage jargon and just tell you what he said, how what the Fed does and how they set their policy and what they do affects mortgage rates and what to expect in 2024. So without further ado, the Fed, who sets the Fed funds rate, it's not like they set the 30-year fixed rate mortgage and they tell you today 6.75 on 30-year fixed rate mortgages, next meeting 6.5%. That's not how it works. But what they do with that Fed funds rate does affect interest rates as a whole. Credit cards, car loans, mortgage rates, all of it. And so today they met and we all knew already that they weren't going to make any adjustments, any cuts to the Fed funds rate, which is just the rate at which banks lend to each other. Let's just call it that, right? They didn't adjust that, but more importantly, and like with most meetings, we know what's going to happen because there's all this lead up and all this talk and all this speculation. We know what's going to happen at the meeting most of the time. But what we stay tuned for and what we want to hear at the press conference they hold after it and during the Q&A is, what are your plans for the future? And so all the conversation, all the questions posed to Mr. Jerome Powell were, hey, you talk about, needing to get inflation under control. What's it going to take in the data when you start cutting interest rates? And I'll tell you what he said. A bunch of words: inflation rate, blah, 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 target, blah, 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 the Fed's mandate, blah, blah, blah. Inflation goals are moving into better balance, right? That's what he said. And so year over year, he referenced 2.9%. The goal, remember, is a 2% inflation rate. So we're moving towards, there's a bunch of data that shows us moving towards the target of 2% inflation before he starts cutting the Fed funds rate, which in turn is going to see mortgage rates come down. In their notes, in the Fed minutes, I'll read from it for you. In considering any adjustments, which means cuts, we'll assess incoming data, the evolving outlook, and the balance of risks. They don't expect it'll be appropriate to reduce the target range until greater confidence inflation is moving substantially towards 2%. And so, of course, everybody at the press conference, like, listen, bro, we're moving towards 2%. When you go from 9%, 8, 7, 6, 5, 2.9, like, that's towards 2, bro. Like, towards 2. I agree. You agree. We all agree. What more is it going to take? He said in so many words, yeah, a couple more reports like the ones we've seen, and we'll be comfortable. So what that tells me as just a simple dude who went to public school is, if they don't cut in the March meeting, for sure they're going to cut by May. And so we have Fed rate cuts coming. What I want to, level set for most people is, even with this talk that they're coming, if you look at mortgage-backed securities today, and I'm recording this literally right after the meeting on Wednesday, January 31st. If you watch this on Thursday the 1st or Friday the 2nd, know that, rates are subject to still move based on how the market digests this stuff and whatnot. But 18 basis points better is less than 1/8% in true rate. Rates move every single day. And so relatively flat. And, this is common for, there not to be a lot of movement if we don't get any new news of anything new to expect. Everything we heard today, we kind of already had an idea of what was going to be said. And so there's no real new news, no breaking news. And that's how I interpret it as well. There's nothing to me that really tells me anything new. They're holding steady. And another question that was posed, I thought was a good one, was, they've got this dual mandate. They got to keep the economy steady and employment, right? Maximum employment or something is the term they use. So what if we start to see some weakening in the labor market, right? Would that be a case to cut sooner? Jerome Powell said yes. If we saw weakening of the labor market, that would be a case to cut sooner. Or if we saw inflation being stickier and kind of like not continuing to move towards their 2%, that would be a case to wait longer to cut. So these are the data points that they're looking at, right? Is the labor market continuing to be strong? We can hold off. Is inflation, heading towards our target? We want to see it get even closer. That's holding off. Inflation continues to move towards 2%. Labor market is, weakening a little bit. Those are the things that are going to create action in the Fed sooner rather than later. So hopefully that makes sense to me, a layman. That's how I look at it. And I try not to, get too granular with things, because truth be told, it doesn't matter to you, really doesn't matter to me. I just want to know, hey, are we going to be in a position where over the spring, rates on mortgages on 30-year fixed rate debt are going to continue to trickle down? And so I'll say it again. I've said it a million times. Rates are going to move down in 2024. They're not going to move down as fast as some people want or think, but that's a good thing. If we have a 30-year fixed rate in the high sixes today, and we have a 30-year fixed rate in the low sixes by the end of the year, and it takes a full 12 months to go down less than 1% in interest rate, that will be a healthy thing for the housing market. Currently, with supply and demand dynamics, most markets have a relatively competitive but flat housing market, meaning in the spring when there's more action and people are submitting offers and bidding things up a little bit, you might see an uptick, 5, 6, 8%. And then on the downturn, when there's less action, there might be a little bit of a downtick. Year on year, you might only see home price appreciation go up 2% when you net it all out. That's my 2 cents. That's all I got. Until next time, we gonna see. Let me know if I can answer any questions in the comments. Like, comment, subscribe. Do all the things that you do on YouTube. If you could, please. I appreciate it. And thanks for watching. Bye-bye.